You spent a decade in school, you graduated with hundreds of thousands in student debt, you're finally earning a real income, and now you want to buy a home. But the bank looks at your debt and says no. Sound familiar? This is the exact situation Dr. Loans were built to solve, and today I'm breaking down everything you need to know, what they are, who qualifies, the real costs, and whether one is right for you. Let's go. The problem doctors face. Here's the challenge most medical professionals run into with a regular mortgage. The average medical school debt is around $215,000. When a conventional lender sees that number, it shoots your debt-to-income ratio through the roof, and you get denied even if you're earning a strong attending salary. Being a doctor poses unique challenges to becoming a homeowner. High student loan debt, limited savings, and delayed earning potential. You enter the workforce later than your peers. You may still be in residency, making $60,000 to $70,000 a year, and you likely haven't had the time to save a 20% down payment. Doctor loans were designed specifically to fix all of that. What is a doctor loan? A physician loan, also called a doctor mortgage, is a specialty mortgage designed for medical professionals. They offer low or no down payments, no PMI, high loan limits, and use more flexible rules when calculating student debt. The lender essentially looks at you differently than a regular borrower. Instead of judging you on what you earn today, many lenders accept offer letters or employment contracts as proof of future income and use projected attending earnings for repayment ability. In other words, the bank bets on your earning potential, not just your current paycheck. Who qualifies? Doctor loans are not limited to just MDs. Most programs are available to physicians, dentists, dental specialists, and podiatrists, and some banks extend the program to other professional degrees as well. Depending on the lender, you may also find eligibility for veterinarians, pharmacists, CRNAs, optometrists, and nurse practitioners. Residents and fellows qualify too. As a licensed medical doctor with an MD, DDS, DMD, or DO designation, you could qualify even if you have student loan debt, are starting residency soon, and have an employment contract with a start date within 90 days of closing. On the credit side, most lenders require a credit score of around 660 or higher, though many prefer 700 or above. Clean credit history is important here. The 4 key benefits. Here's what makes doctor loans genuinely powerful. 0 to low down payment. Doctor loans require no down payment for loan amounts below $1 million, and borrowers are not asked to pay any private mortgage insurance. That's a huge deal when your savings are tied up in student debt repayment. No PMI, ever. On a $600,000 home with a conventional loan and less than 20% down, PMI could run $300 to $500 a month. With a doctor loan, that cost simply doesn't exist. Student debt treated fairly. Doctor loan programs use more logical calculations based on your actual career stage. For residents or fellows, some programs allow flexible treatment of deferred or forbearance student loans, drastically improving your qualifying power. For practicing doctors, lenders typically use your actual income-driven repayment payment rather than a percentage of your full loan balance. Higher loan limits. Traditional conventional loan limits are around $832,750 in most areas, but physician mortgage loans often go up to $1 to $3 million, giving you far more buying power without jumping through the hoops of a jumbo loan. The trade-offs. Doctor loans aren't perfect. Here are the honest downsides. Slightly higher interest rates. Interest rates on physician mortgages are typically 0.125% to 0.375% above conventional loans, the trade-off for no PMI and flexible DTI treatment. Over a 30-year loan, that difference adds up, so always run the full cost comparison before deciding. Primary residence only. Physician loans are generally limited to a primary residence. They cannot typically be used on an investment property or vacation home. Not all lenders offer them. These are specialty products. You'll need to seek out banks and lenders that specifically market to medical professionals, and it's worth comparing at least 2 or 3 offers to get the best rate. The bottom line, use a conventional loan when you have 20% or more down and your DTI is under 43% without special exclusions, but run both scenarios with a lender to compare total costs. If you're a medical professional with student debt, limited savings, and a strong income ahead of you, a doctor loan could be the smartest path to home ownership right now. You don't need to wait years to save a down payment. You've already done the hard work. If this video helped, hit like and subscribe. We cover everything from first-time buyer loans to specialty programs like this one. Drop a comment below. Are you in residency, fellowship, or already attending? I'd love to know where you are in the journey. See you in the next one.